Higher interest rates tend to expose vulnerabilities in the system. Where do you see those vulnerabilities?
Yeah, so I think in the banks we have seen some of the stress. Now, SVB was an extreme outlier. It was, badly managed, had risk on the asset side and the liability side of the balance sheet. And when inflation surprised to the upside, those risks were triggered, and the bank imploded very quickly. Other banks have these exposures, but most of them to a lesser degree. The good thing is that capital and liquidity is much higher today than it was in the 2008 crisis, and we have not seen a sharp rise in credit risk at the moment. But we also worry about the non-bank financial sector. So the LDI is one example. In the pension segment of the UK, we saw Grenzel and Archegos, and there could be other stresses in the non-bank financial segment as well.
So elevated stresses right now, potentially. The big question that market participants are asking is whether these episodes that we saw in the US, obviously in Switzerland as well, has been a focus in Europe, are idiosyncratic events or systemic events. And I look at a couple of charts that you published today. In the case of US banks, it seems to me that there's still potentially a lot of unrealized losses that could hit US banks should they mark to market on some of their interest rate sensitive portfolios. How worried should we be about that, given the potential for a systemic episode?
So I would frame it in terms of inflation going forward. So what is priced in markets is that inflation will come down, fairly quickly, and interest rates are going to decline as well. Yield curves are sharply inverted. And that would be positive news for those banks with unrealized losses, because the mark-to-market value of those securities would go back up. So the unrealized losses would disappear. This is how banking normally works. They hold to maturity, so they might lose for some time, but then they might win again, and nothing happens. Of course, there are a number of banks with exposures to these unrealized losses, but we also have a very strong safety net, in particular in the US. So the systemic risk exemption was used in the US to backstop the deposits, even the uninsured deposits of those banks that were under stress, and that contained the problem. So I would expect that the policy tools of the central bank, the Federal Reserve, and the deposit insurance are strong enough to contain those stresses.